Hello, boys and girls. Um, let's see. This will be the first of hopefully many comments on latest news and uh, goings on in the world. I randomly opened this page on CNN.com to see how this will work. I will try to comment the latest news, at least from my own perspective. And what do I get? I get this wonderful article saying finally exclamation mark Fed raises interest rates. Now, I have to admit I'm not an economics expert. I'm not an economist at all. I do happen to know a little bit about how the markets work, mostly through a stint of trading on the foreign exchange market, or as it's known, Forex. A couple of years back, I spent basically a year and a half looking into all of these interest rates and big news and farm payrolls and whatever it's called, trying to make a buck. Unfortunately, that particular idea about earning money never really materialized. I'm still hopeful though. However, it gave me a certain background to be able to comment on these things. So I'll just make an intro about, actually, I'll just try to read what the first couple of sentences in the article say, and then some of my initial thoughts on the matter. So it says, America's first interest rate hike in nearly a decade is here. The Federal Reserve raised its key interest rate on Wednesday from a range of 0% to 0.25% to a range of 0.25% to 0.5%. It's an immense increase of total of 0.5% delta. Okay, now this was my comment. Now let's continue with this wonderful news item. The rate hike is a small one, yeah, really, but it will affect millions of Americans, including investors, home buyers, and savers. Yeah, savers will eventually see a little more interest on their deposits at the bank, and mortgage rates will gradually rise. What are these people talking about? Which little more interest? Now, according to what I know, it is doubtful that the banks will ever pass this increase on to the savers. They might pass it on to the borrowers, though. But even if they do pass the entire increase, what is the? I mean, we're talking about going from what 3% to 3.25%. Okay, let's say that it's that it does represent an increase for people who save lots of money, hundreds of thousands, probably millions of dollars. Yeah, in that particular case, this kind of increase can mean a big bag of green bills. But if you are just a guy or a girl trying to earn some money to get by, to put food on the table and feed your family, pay for your mortgage and whatever, I don't really think this is going to affect you at all. However, let us continue with the news. The move was widely expected. It is a sign of how much the economy has healed since the Great Recession. Okay, they're calling it the Great Recession. That's very nice. Next, the central bank believes the U.S. economy is strong now and no longer needs crutches. Okay, so going from 0 to 0.25% means that the economy doesn't need crutches, really. Why didn't they go to... Okay, now this is the point that I'm trying to make. Basically, what I'll try to do in these short YouTube videos is, have you ever felt it that you're reading the news? Actually, you might have felt it while watching the TV, but I'll focus on reading the news on the internet. And you see something that is so obviously wrong, perhaps in several different ways. And you feel like yelling at the person who wrote it. However, you do not have the opportunity to actually yell. You might end up leaving a comment in the comment section, which might or probably will never be read by anyone who actually wrote the thing, or they might not really care about it. They might be writing it just because they have their certain agenda. Well, I will try to use these videos as my own platform for voicing this kind of sentiment. So if I find something that is so obviously, outrageously, insanely stupid or wrong, at least from my own perspective, I'll try to say something about it and let you guys know. So you can comment, you may not, you can agree, you can disagree, and so on and so forth. So basically, the first question that I would ask these guys, they might have asked themselves, but I mean, they're making an intro. Okay, let's try reading to the end of the article. Perhaps I will give them a chance. So I will tell you now, and if we hit the end of the article and they do mention what I'm mentioning in a way which is prominent, because how many people actually read the entire article? Probably most of us read only the title for most of the articles, and then perhaps the first paragraph, and then if it's really interesting, for a couple of paragraphs more, and then if it is really, 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 really good and interesting and something that we really care about, we might read the entire article. So it's not the same if you put something in the first or second paragraph and if you put it in the 25th, obviously. Okay, so let me just say what my problem with this is, and then I'm just going to look through the rest of the article, see if they're mentioning it and where. What is the historical interest rate? What are the historical interest rates set by the Fed? Now, this whole thing can be quite confusing in terms of the Fed, as well as several, I mean, pretty much every other central bank has several different rates which they set, and they set it in ways which might not obviously, which might not always be really obvious in terms of how the mechanics of it, in terms of the mechanics of how the central bank, whether it's Fed or some other central bank, manipulates the money supply, and how they set these interest rates, and how they do the quantitative easings, and whether they outright buy or they borrow, blah 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 blah. Now this can be quite involved. To tell you the truth, I mean, it has happened to me several times. I read it, I understand it on a conceptual level for one central bank, and it doesn't really apply for the others, and then I forget it. A couple of days later, I forget the details. So let's focus on the big picture here. So there is something called, I mean, there is some like benchmark interest rate, which the central bank in some way sets. And this interest rate is benchmark in terms of it's like a basis interest rate that then affects the rest of the lending in the economy. So the commercial banks and the banks and the blah, 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 they also, by one way or another, are linked to this interest rate in terms of the interest rate that they offer to their to the people who save money, and the interest rate that they give to the people who borrow money from it. And of course this cascades throughout the economy, and then you get, of course, the average Joe or Mustafa in the case of my country, being able to, I mean, also being affected by the whole circus of interest rate. So basically, if you want to buy a home, if you want to start a business, there's, of course, you usually, I mean, most of us do not have the cash to buy it outright, and most of these things are not even, I mean, the way the economy is structured today is like you're not meant to buy everything by cash or not even pay for most of it, but rather you're like pushed into this direction of taking credit for everything. I mean, borrowing for everything, and then of course the interest rates available in the economy affect you. Of course, you're never going to see the kind of interest rate that they're talking about here. So 0 to 0.25% for whom? Can I go to the bank and ask for this kind of interest rate? Of course I can't. So this is like a basis interest rate, which might, I mean, again, we're going into technicalities, and I mean, but the bigger you are in terms of being a big fish, the closer you are to these supposed central bank interest rates, and then the farther down you go, the more the average Joe you are, you get compounded with the layers of intermediaries charging up these interest rates. But this can be a nice topic for another show once I get the chance to read up about it. If some of you would like to leave comments, please do. But from what I've been told, these YouTube ads tend to, I mean, also rely on the number of comments you put, so negative comments also bring me money. So please criticize me as much as you want. Now, the issue here is that basically, so what is the average? What is the average interest rate set by the Fed in the last, say, 50 years? So we're talking about, because they said that it's like, let me just try to read it one more time. They said like, the move was widely expected. Okay. It is a sign of how much the economy has healed since the Great Recession. The central bank believes the U.S. economy is strong now and no longer needs crutches. And since someone said that the move marks the end of an extraordinary period of low rates. Okay. So it's like an indicator that the economy is now, it's strong. Now it's U.S. economy is strong. Hopefully the rest of the world is also strong because the U.S. is strong. Let's say. So let's see. Interest rates. Let me Google it. Fed. Okay. Fed interest rate chart, perhaps, or perhaps I can also put in historical. Okay. There's something called the graph effective federal funds rate. Let's suppose that we're talking about this thing. We'll see. When we open the graph, if we see something going down to zero in the 2000s, in the late 2000s, and this is the kind of map we're looking for. Just a second. Let me actually open the Google Images chart first. So yeah. We've got something here. Says historical chart, Fed interest rate, United States interest rate, benchmark interest rate, and then I've got it going from, okay, so from January 76 through January 2008. Now, after the January 2008, I get like a, like when they show the patient dying on the TV series, and like the heart rate flatlines, and now I'm getting this thing for the interest rate after 2008. So basically it's like constant zero. But I'm looking for example, let's say we go from until 92. So let's say the minimum and the maximum values of the interest rate between January 76 and January 92. So this is like 6 and 10 is usually it's 16. Sometimes it might be 17 if you are, well, in a different universe where the laws of mathematics and physics and stuff do not apply. Anyway, from January 76 to January 92, the minimum was about, basically it was after the January 92. So I'm going to say something around 5% was the minimum reached just on January 76. So this is the minimum. 5%, people. I'm talking about 5%. Let me remind you that they have raised the interest rate from 0 to 0.25%. So the difference between the minimum rate on January 76 and the current rate now is still 4.75%. But this was the minimum rate. Now, the interest rate really spiked back in the, I'd say late 70s, early 80s. That might have had something to do with some global events, for which I might have been too young to remember. Perhaps some oil crisis in the Middle East. I'll try to Google it. Some war in the Middle East, or some. When was it that the Nixon closed the? Was it who closed the gold window? Anyway, perhaps it's worth another show. Just give me a chance to read up about it, to just like a refresher. Anyway, we have a spike at around 20%. So basically, January 76 around 5%, the minimum, and it wasn't broken. I mean, it didn't go below it until about, I don't know, perhaps 93, 94, where it reached actually 3%, but still way. So 3% is still way above 0.25%. Okay, but in this period of basically the entire period until something like 92, January 92, with like a small exception in perhaps the late 60s and early 70s, the minimum 5%, the maximum 20%. So historically speaking, and you can see that the further down you, how should I, the more you approach the modern age, the more you approach the present. The average interest rate, they still go up and down, but the average interest rates that tends to go down until, of course, flatlines. It reaches zero in the 2000s. Probably is it, we could, of course, we might want to use additional data, but this is probably because the printing urge got really strong in the 90s. I'd say perhaps with the advent of with Mr. Alan Greenspan in the Fed chair. So I've heard nice things about him. Not, but I suppose that this general easing, which then led to the initial stock market crash in the early 2000s. This was the interest rate here is reflecting the policies of Mr. Greenspan. In any case, even Mr. Greenspan would be like a very conservative person compared to who is running the Fed now. Why do I care about the Fed not being an American? Of course, because your money, guys, is also the money which is used by everyone else, including my own central bank as reserve currency, not gold. So naturally, even without your wonderful imperialism, I tend to be at the receiving end of the decisions made by your Fed chair. So that's why I'm looking at this interest rate things with keen interest. Anyway, so until the early 90s, we're talking about 5 to 20% range of interest rate. Now we're talking about going from 0 to 0.25. Now, this I would not like to make this an hour-long video, but this should, or audio actually. I'm just going to put a few nice pictures on it so you can look at something while you're listening to my wonderful voice. Anyway, this as the Germans say, lächerlich, like laughable. What they're, I mean, it's not laughable that they're increasing the interest rate. Well done, but trying to represent this as some kind of a historic move, and probably what's going to happen in a, as some people have probably been pointing out, like that Peter Schiff guy. Peter Schiff, I have how should I say it? I might not agree always with the man, but I have a great deal of respect for him and his opinions, and I can guess what he's saying right now about this news. Like, it's not going to last. Even this kind of interest rate hike is probably going to burst some kind of a new bubble, whether it's in the stock market or in the real estate market and so on and so forth. Anyway, closing the video. So this is the yelling part was like, what, you idiots? It's like, it's nowhere near the historical range of the interest rates, and you're trying to represent it as some sort of a revolution. The media or whoever is writing this for CNN money. Anyway, let's just go to the end of the article so you can listen to me pronouncing your or slaughtering your wonderful language, or the language that you kind of borrowed from the English, as they're the original owners of the language, which is called English, obviously. Anyway, never mind the English language. So, let me just read it to you. I feel confident about the fundamentals driving the U.S. economy, the health of U.S. households, and domestic spending, Fed Chief Janet Yellen said during a press conference. There are pressures on some sectors of the economy, particularly manufacturing and the energy sector, but the underlying health of the U.S. economy I consider to be quite sound. Very nice. Very nice. Okay. The Fed telegraphed it will be patient. What does it mean that they telegraphed? To who? To whom? To whom? To who? No time for going into the details of the English grammar right now. So let's just leave it there. The Fed telegraphed it will be patient with future rate increases so as not to kill the economic recovery. Yeah, they will be patient. The central bank statement said the economy will only merit gradual increases. So by 2035, you might get to the 5% minimum of 1976. Yeah, at the rate these guys are going. Which are likely, so they're going to only use, we're only going to get gradual increases in rates, which are likely to remain low for some time. Yeah, really low in terms of historical values. Yellen repeatedly said during the press conference that future rate hikes will be gradual. Stocks rallied with the Dow rising over 100 points after. Now, this is going to be probably another video, but this kind of the stocks rallied, or the stocks fell because the Chinese economic data, blah blah blah. You should not. I mean, my forex experience is like, the news are really not the best of drivers of these things. Usually they can. I mean, it's not like that the news cannot drive this, but sometimes they're driving in the opposite direction. So basically, I'm speculating right now. People knew this was going to happen, and everyone who wanted to get rid of to sell or short sell the U.S. stocks did it by now, and this might have been just a small correction in the opposite direction, which might be followed in the months to come with a continuation in the downward slide of the stock values, because the booze is not as plentiful as it was, but it will be pretty plentiful at these interest rates. Of course, the Fed interest rate is not the only thing regulating the flow of the money into the economy. Of course, you have like several layers of banks regulating exactly how much money goes into the real economy and ends up being used to speculate on stocks. Sorry, invest, not speculate. Anyway, investors were pleased to see that the Fed expects only gradual increases in rates next year, and that the committee explicitly said it would take into account readings on financial and international developments. Oh, so like a terrorist attack somewhere in the West, or some key ally of the West might affect this, and the people on the stock exchange will be very, very concerned about this terrorist attack. They might decide to sell the stocks because of this. Of course, this is like the ways that the media will try to represent it, but basically they what they usually do, in my opinion and my experience, like they take whatever headline news there is that day, and they try to explain the happenings, the goings on in the market with that headline news. So for example, the market crashes and there is a terrorist attack, and they will say, okay, the market crashed because of the panic caused by the terrorist attack. Although the actual fundamental reasons for the crashing were something entirely different, not in any way connected with the actual event. Okay, just let me read to the end and then I'll stop. The Fed put interest rate near zero during the financial crisis in December 2008 to help stimulate the economy and boost the collapsed housing market. The economy is no longer in crisis. In fact, it's a lot healthier. Unemployment now is at 5%, half of the 10% rate it hit in 2009. Of course, one might wonder here what kind of unemployment, because you have different structures of unemployment. Some kind of jobs. I mean, it's not enough to say it went down from 9% to 5%. I mean, or let's say like it went from 5% to 9% and back to 5%. Someone might represent this as a recovery. But for example, if you had 100,000 engineering jobs, well-paid jobs, long-running contracts, and then this is transformed or replaced by 100,000 temporary McDonald's jobs. Of course, this is not going to be the same. The actual, the absolute number of jobs might be the same, but the quality of the job, or the structure, it's full-time or part-time, is not going to be the same. So this kind of figure doesn't, I mean, it tells you something, but it doesn't really tell you the whole picture about unemployment. Let me go on. Over 12 million jobs have been added since the recession ended. Wages, which have barely grown during the recovery, have also started to pick up recently. On Wednesday, of course, we might one day decide to do a separate segment on the kind of, I mean, the wages have not picked up, and then they'll probably say that the inflation was really low, so it doesn't really matter. But we might look into this inflation not being low or not being low, or the real figure not being available, or blah 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 blah. Anyway, this is also a question mark. I mean, if I was reading this for myself, there would be a question mark here also. So on Wednesday, the Fed's committee improved its economic outlook compared to its last forecast in September. The Fed raised its expectations for growth next year to 2.5%, up from 2.3%. Of course, they tend to also, the figures that they give, sometimes they tend to magically revise them downwards a month later. So they might say that the figure for something is 2.4, and then you go and look at the same figure a month later, and then you see that they have revised it down to 1.7. So you cannot always, also you cannot trust these figures. They might, there's a real likelihood of them being revised in a in the coming month or so. So they lowered the Fed lowered its projection for unemployment to 4.7, down from 4.8. The Fed still has low expectations for inflation. The central bank has two goals: low unemployment and stable inflation. The Fed's target for inflation is 2%, but right now it's close to zero. Of course, you might want to think about it, look into the products, look into what is actually counted in inflation and why some things are counted, why some things are not counted in inflation. You can look at your own costs of living and see if they have increased close to zero in the last 7 years, of course. I'm pretty sure that they have increased a little bit, perhaps a lot, more than 0%. The Fed sees inflation inching up in the years to come, but not hitting 2%. And of course, there's a whole story about, at least the one I've read as a non-economist person, like how they did it. But basically, what the inflation is supposed to be, at least from the way I see it, is supposed to be something that tells us, the average Joe, or in my case, the average Mustafa. My name is not Mustafa, by the way, but never mind. Let's call me Mustafa. Anyway, the way I see it is supposed to be like, okay, Mr. Mustafa or Mr. Joe, the inflation is 3%, which means like your cycle corrected your increase in the cost of living, corrected for slight variations, cyclical variations, might be 3% for the last year. So this should generally fit in with my own experience of these expenses rising roughly that amount. Of course, depending on my lifestyle, depending on where I live, the kind of lifestyle I lead, it might be less and it might be more than 3%. But this should be generally in that range. But the way I see it, we have basically shifted to a place or to a stage in which this interest rate doesn't really mean anything in terms of meaning something to the average Joe, because they take out a lot of it and they correct, and they use these models and to correct for the increase in the technological efficiency of blah 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 blah. And then in the end, this is a figure which they use in their models, but doesn't really relate to. I mean, you can yell until you're tired about, yeah, no, my costs of living have been increasing. What are you talking about, 0%? But they're just going to say, okay, but you know, sir, this is not the scientific method. We're not blah 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 blah. So basically, this inflation figure, it's like, so what's the point? I mean, they're trying to reach a 2% inflation, but if this inflation doesn't really represent anything meaningful to you, so what's the point of the figure? It's like some model representing something which might or might not even be, I mean, remotely connected to anything real, let alone representing something that is immediately, tangibly real to you. I'm probably talking too much, so let me just end this by, let's see, just one sentence remaining. Known as liftoff, the Fed's action is expected to be the first of more rate increases. It will probably come in 2016. The last rate hike was June 2006. Of course, as I have predicted, they have never, they haven't even mentioned the historical interest rates in the U.S., let alone mentioning them in the 23rd paragraph. They didn't even hint about the increase not being anywhere near the something like historically expected levels and so on and so forth. So this is the kind of media, this is the kind of journalism that I really, really hate. And let me remind you, this is on CNN's homepage. This is the top splash article on CNN.com. Yeah. So, what do you think about the media, huh? Okay, guys. Bye-bye. Until next time.